Good morning, traders. This is Brad Matheny. Today is the December 10th. As we're moving very close to Christmas, only 2 weeks away, I wanted to highlight this longer term chart. I am constantly amazed at the number of people who are pitching for a massive collapse. I mean, they're talking 3,200 to 3,000 on the S&P down in this area here. And it seems like every week someone's going out and talking about, oh my gosh, everything's going to collapse. You don't understand, the world's going to end, and the dollar's going to fall, and oh my gosh, it's just ridiculous. So understand that where we're at in this area is that we have a 5 wave countdown, and this is what I want to highlight in this setup. We're near the end of the year. Volatility is lower, volume is lower. Traders have pulled a lot of capital away from the markets already, institutional traders and retail traders. This is called a tax loss selling. If you have a loss in a stock, what you do is you sell it before the end of the year so you can actualize the loss, then buy it back early next year so that you can get back into your investments and essentially book in the loss for the IRS. Now, what's happening to us was we've seen this Fed rate raise to try to stave off inflationary concerns. Inflationary concerns are coming down. We've got a very solid A, B, C, D, E pattern to this low. This could be the end of the move. This could be the bottom, which I've highlighted here with the green arrow or the green box, or this could just be wave one of a broader extended downtrend. But in my opinion, for us to get beyond, now remember, this is weekly, and what I'm trying to do is show you again, we've had these growth channels taking place for many, many years. So in fact, let me come over here to monthly, and I don't have monthly. Oh, monthly. And just for the fun of it, okay, you can see we have this big speculative phase here, which was the dot-com bubble. Then we had the deflationary phase. Then we had the recovery phase leading up to the global financial crisis. Then we had the global financial crisis, which remember was where is it? This was a roughly $20 trillion event. Okay. The global financial crisis was a massive event. It was bigger than many of you can even consider, but when someone's talking to you about what is actually taking place, this was a $20 trillion event. This was possibly a 1.3 to $2 trillion event. This was actually 20 trillion plus, because in reality, the derivatives market was even bigger than what most people thought. Okay, so we need at this point to see some type of a collapse. We've seen, so let me show you here. So from this point here, we have seen trying to get this to where it does what it needs to do. We've seen a 48% collapse. Now duplicate and drag this over here. If I remember right, this was like a 62% collapse. 59% collapse. And from over here, we have seen there we go. From these upper levels down to roughly this low. We've seen a 28% collapse. Okay, dollar wise, this has been much bigger. So we've gone from 4,800 roughly on the SPX down to 34, call it 3440. That is again 4,800. That's a 1,400 point collapse. This was a 700 point collapse. This is a 1,000 point collapse. This is a bigger price collapse than percentage collapse. And we need to understand that even if we were to come back down into these levels, we would see some broad catalyst. It would take some massive catalyst to actually collapse. So when we come into here and we take a look at these 2017 lows up to our current highs, and we try to move right across that level, we've had a very solid 618% collapse from this high up here down to these lows down here. It's tagged the 618 level and is currently back above. Let me spread this out. Currently back above was above the 382, is above the 0.50 level, and trying to find some support. But what I wanted to highlight, ladies and gentlemen, was that when we start taking a look at the longer term, I want to use this one. When we start taking a look at from, say, 73, 75, we start going across this high and down to this low as a support channel fan, we're well above those levels. As a lot of people would say, well, we could come all the way back down to these levels. In my opinion, we can't. We've spent so much time and money, literally close to 20 trillion in supporting this move. Where we're looking at in terms of trying to get up into this channel would be something along the lines of, and if I were to grab this again, oop, wrong one. If I were to estimate this type of a move, I would come almost into that area, okay? In the sense that we've printed. So in this area, from 1990 roughly up until 2000, we had printed about $4.5 trillion up into this economy and produced it. We were moving into a global economy at this time. At this area, 95, 96, 97, I was traveling all over Asia and Europe. And American companies were moving from the late 80s into the 90s. They were moving all over the world, setting up shop. Western Digital, Intel, you name it. They were, I mean, the world was becoming connected through the internet and becoming computerized. And we were elevating the world population at this point in time. Then we went through this stagnation phase. And then from this period of time here, after the global financial crisis, we went from about 10 or 11 trillion dollars in debt in the US up to close to 24 trillion dollars in debt. And you figure out the math. That's about 13, 14, 15 trillion dollars that we put into the global economy, not counting what the world banks have done. This is why we have this growth phase. So in my opinion, like I said, ladies and gentlemen, we're really looking at kind of a scenario like this as a support channel, and possibly more like this as a medium support channel, and this as potentially a middle channel here where we could see some very real long-term support. So I'm going to try to highlight these and come to this one and highlight this as intermediate support. And that's why, ladies and gentlemen, I believe we are very close to a solid base and bottom here. I believe that this base here is going to provide us some moderate support. And the only thing that's going to take us back below this level would be some catalyst, some sort of a massive catalyst collapse in the US and global markets, which I'm not seeing yet. So understand that where we're at with regards to the markets is we are likely going to slide into, go back to daily, we are likely going to slide into the end of the year with not too much excitement, trading probably right around this channel, this upper channel here, call it 339.17 to 40.25. just before Christmas. And then after Christmas, I think people are going to become aggressively positioning for the start of 2023. That means we basically have 2 months of sideways volatility. So if I were to use a box, I would say possibly something like this. That's January, December 28th. So I would say possibly something like this for the next 2 weeks. So it could have a little bit of a downside rotation as tax loss selling elevates potentially, and then we might kind of stall out by the end of the year above 4,000 on the Standard & Poor's index, S&P 500 index, and then in early 2023, I think Q4 2022 numbers are going to start to really drive the market a bit higher. I think the Fed is going to become very responsive to weakening inflation numbers. And that means that as we take a look at the TTScanner Hotlist, the value index is starting to show some real positiveness. Remember, I highlighted these bullish triggers all last week about how everything went from bearish 4, 5, 6 weeks ago. Everything was bearish. Now look at all these bullish triggers coming up. And we're starting to get some really solid lasting triggers. Remember, when the market was flat for the last 3 or 4 weeks, we get triggers and they'd roll out a week or two later. Now we're starting to get some triggers that are lasting 3, 4, 5, 6, 7 weeks. And that's what's going to happen as this trend continues. You're going to find that these weekly swing trading triggers are going to be lasting much longer and start to accumulate target 1 and target 2 levels more effectively. So pay attention. A lot of these triggers might be good early warning triggers that we're looking at a early 2023 kind of a melt-up trend. Walmart, T-Mobile, McDonald's, International Business Machines, Smuckers, Cummins, Amgen, Merck and Company, PFG Financial Group, Travelers, United Healthcare, all of these are moving upward. These sectors are typically moving upward as well. Consumer staples, healthcare, and some industry like an International Business Machine and McDonald's. Now, next we have the TTScanner Core Inverse List. Core Inverse List has gone totally bearish, except for we have ProShares SVXY is bullish. And again, this is a short interim VIX system. So this is basically expecting the VIX to move flatter. But again, inverse ETF moves short when the market is moving higher. The core system, which is right here, this is the core ETF list, is starting to move bullish as the market moves higher. We have a new trade in PB&J, Dynamic Food and Beverage. We have existing trades here, many weeks long, but we're starting to get long triggers here. So pay attention. This is probably going to move into a couple of new long triggers over the next couple of months, which could be very good multi-month, possibly multi-year types of triggers. And lastly, we have the TTScanner hot list moving into accumulation and bullish. We have one new trigger in aerospace and defense, ITA, aerospace and defense, brand new trigger here, but we're holding our own. These are older triggers. This is a new trigger for next week, but we are moving into bullish. You're seeing about 50% of these symbols are moving back into bullish, which means we should start to see some real solid upward trending. So really the reality here, ladies and gentlemen, is we have to survive the next 4 or 5 weeks through the end of the year and into early 2023 without becoming overly aggressive. Watch my custom index chart for more clarity as to what's really happening in the market. But the reality is, ladies and gentlemen, get ready. I think we're looking at a good, solid shift into very big bullish trending in 2023. All right, guys, follow me on Twitter, follow me on YouTube. Let me know what you think, and get ready for some big changes coming in January 2023.